This isn't a lie, it's true. In 1929, 6 months before the stock market crash, Joseph Kennedy took 3 specific steps. He sold his investments and moved to cash. He bought gold. And he positioned himself to profit from market fluctuations. When the market finally fell 89%, most investors were ruined. But Kennedy walked away with $50 million. In 1987, Paul Tudor Jones repeated the same 3 steps: cash, gold, and volatility. On October 19th, the day the market fell 22.6%, he made $100 million in a single day. In 2008, during the global financial crisis, Burry, John Paulson, and others followed the same 3 steps and made billions, while the financial system collapsed around them. And now, in 2025, major investors like Warren Buffett, Ray Dalio, and Bill Ackman are following the same pattern. Not 2 trades, not 5, 3. The same 3 steps that have worked before every major market crash of the last century. These strategies aren't random, and they aren't based on luck. They follow a repeating pattern because market crashes occur in the same sequence. Prices rise too high, debt becomes too high, a triggering event occurs, panic selling begins, and the system crashes. Investors who recognize this in advance position themselves accordingly in every cycle. Understanding this pattern gives you a choice. You can ignore it and hold your investments during the crash, as most people do, risking losses of 30% to 50% or more. Or you can understand where we are in the cycle and prepare. All 3 trades have already begun. The pattern is repeating. A major decline is coming. Why just 3 trades? Why not a longer list of strategies? Because market crashes follow a predictable chain of events. All 3 trades fit into a specific step in that sequence. The first stage is awareness. Experienced investors see that prices have become unrealistic and that the risk potential now outweighs the reward. This is when they exit and move into cash to protect their wealth before the crash. The second stage is wealth protection. Sitting in cash leaves you exposed to inflation and currency fluctuations. So these investors buy gold or other physical assets that retain their value, even when financial markets and currencies fall. The third stage is profit seeking. This occurs when they use financial instruments whose value increases during market fluctuations, such as volatility bets, put options, short positions, or credit insurance, to make money when the market falls. These 3 steps together form a complete strategy. The first protects you from losses. The second protects you from inflation and currency depreciation. The third allows you to profit during the crash itself. And after the crash is over, the fourth step comes automatically, using your saved cash and profits to buy valuable assets at the market's lowest level. Before reaching this final step, it's important to look at how the first 3 trades have played out in nearly 100 years of market crashes. The first trade, moving into cash, typically occurs 12 to 18 months before the crash. This is the earliest warning sign, indicating that the smartest investors have sensed the danger and are exiting, while everyone else is still in a hurry. Let's look at how this strategy worked during 4 major market crashes. In 1929, Joseph Kennedy was known as one of the boldest stock traders of the booming 1920s. He earned millions by helping drive stock prices up, so insiders could sell at the top. By early 1929, he owned large amounts of many popular stocks. The market was filled with excitement. Stock prices had tripled in just 5 years, and nearly everyone wanted to buy. People were borrowing huge amounts, up to 90% of a stock's price, to purchase even more shares. But Kennedy understood the risk. When almost everyone has already borrowed and invested, there are no new buyers left to support rising prices. Even a small drop can trigger a chain reaction. borrowed investors are forced to sell, which pushes prices lower, causing more forced selling. Kennedy had seen this pattern before. So during the summer of 1929, he slowly sold his stocks and moved his money into cash, so he wouldn't draw attention to his actions or hurt prices too quickly. By September, he was mostly out of the market. The Dow Jones hit its highest point on September 3rd. Just 7 weeks after Kennedy stepped aside, the crash began on October 24th, Black Thursday. While everyday investors watched their savings disappear, Kennedy was safely in cash and prepared for what came next. A similar story unfolded in 1987. Paul Tudor Jones ran a successful hedge fund that traded stocks and commodities. But by mid-1987, he became very worried about how high stock prices had climbed. The Dow Jones had risen from under 1,000 in 1982 to over 2,400 by August 1987, more than doubling in 5 years. Borrowing in the market was rising again, and a new form of automated computer trading was beginning to create instability. Jones studied the data carefully and became convinced that a crash was coming soon. In August and early September, he began selling stocks and building up cash. He even told his investors that he expected the downturn to hit in October. This was not a vague guess. He gave a clear timeline. By early October, he had safely moved into cash and positioned himself for the other 2 trades. The market peaked on October 2nd and then collapsed on October 19th, just 17 days later. Jones was already out before the worst hit. The 2008 crisis was more complicated because several investors spotted the danger at different times. Michael Burry was one of the first. In 2005, after closely studying the housing market, he became convinced that risky home loans would cause a financial disaster. At that point, he stopped buying stocks and shifted into a protective position instead. He knew the housing bubble would eventually burst and drag the entire economy down with it. Michael Burry raised cash and held onto it while preparing for the second and third trades. John Paulson reached the same conclusion a year later, in 2006. He could clearly see that the housing market was in a dangerous bubble and believed it would eventually take down the major banks. To prepare, he launched a special investment fund designed specifically to profit from the housing collapse, which required gathering large amounts of cash from investors ahead of time. Warren Buffett, who is known for being extremely cautious, also began increasing his cash holdings in 2006. Berkshire Hathaway's cash balance rose from $40 billion in 2006 to more than $60 billion in 2007. Buffett explained that he simply couldn't find anything worth buying at the prices being offered, meaning stocks were too expensive. The market peaked in October 2007, and by then Burry, Paulson, Buffett, and others were heavily positioned in cash. As the crash intensified throughout 2008, they were protected. Fast forward to 2025, and Warren Buffett is now holding around $325 billion in cash, the largest corporate cash position ever recorded, both in total size and as a percentage of Berkshire Hathaway's assets. He has been steadily selling stocks to build up that cash, including reducing his Apple stake by half and selling portions of Bank of America. He is not buying anything new. In his 2024 shareholder letter, Buffett stated very clearly that he cannot find anything priced attractively, which is his way of saying the market is overvalued and investors should be cautious. He is not alone. Jeff Bezos has sold more than $13 billion worth of Amazon shares in 2024 and 2025. Mark Zuckerberg has sold billions of dollars of Meta stock even as the company reached all-time highs. Jamie Dimon, the CEO of JP Morgan Chase, sold company stock for the first time since becoming CEO. Across American corporations, insider selling is at levels not seen since 2007. These are the people who know the true financial conditions of their businesses: sales numbers, customer behavior, and internal risks, and they are choosing to convert their holdings into cash. The first trade of the pattern is happening right now. The most informed investors have already stepped aside. This is the same behavior seen before the crashes of 1929, 1987, and 2008. A steady exit 12 to 18 months before the downturn. The second trade, buying gold, usually happens during this same 12 to 24-month period. Investors who are sitting on cash need protection from inflation and declining currency value, and gold has served that purpose for thousands of years. To understand how this worked historically, consider the year 1929. Bernard Baruch was one of the most successful investors of the early 1900s. He had made fortunes during previous financial panics by recognizing bubbles before they burst. In 1929, Baruch didn't just move to cash. He also bought large amounts of physical gold. He believed the coming crash would first create deflation and then push governments to manipulate currency, eventually leading to inflation. When the crash hit, gold kept its official price at $20.67 per ounce. But the real payoff came in 1934, when President Roosevelt reset the price of gold at $35 per ounce. Anyone holding gold saw their purchasing power jump nearly 70%, while stocks were still falling. Baruch had positioned himself perfectly, and by the mid-1930s, he was wealthier than he had been before the crash. Gold played a different role during the crash of 1987, because that crash happened in a single day, and the market recovered fairly quickly afterward. Even so, investors who bought gold ahead of time, in 1986 and early 1987, still made money. Gold was about $300 per ounce in early 1987, and during the October crash, it jumped to around $475 as investors rushed to move their money into something safe. That was a 58% increase before prices later eased when the panic passed. The strategy worked because gold protected wealth at the exact moment fear was highest. Paul Tudor Jones held gold as part of his defensive approach, and it paid off. In 2008, gold became even more important. Gold was around $600 per ounce in 2007 when well-informed investors began to prepare. As the financial system unraveled through 2007 and 2008, banks collapsed and the Federal Reserve started printing huge amounts of money to stabilize the economy. Gold climbed rapidly. By March 2008, it reached $1,000. By 2009, it was above $1,200. In 2011, it peaked at nearly $1,900. After earning billions from betting against mortgages, John Paulson invested heavily in gold because he understood what would follow. Printing money weakens the currency, and when the currency loses value, gold rises. His gold fund generated billions more on top of his mortgage profits. Investors who held gold from 2007 to 2011 tripled their money during a period when the overall stock market barely recovered. Now, in 2025, the second trade, gold accumulation, is more important than ever, and it is happening on a massive global scale. Central banks around the world have been buying record amounts of gold. Between 2022 and 2024, they bought more than 3,000 tons, the highest three-year total since tracking began in 1950. Countries like China, Russia, India, Turkey, Poland, and Singapore are all building large gold reserves. They are reducing their reliance on the US dollar because they see the same risks the top investors see: growing US debt and the likelihood of currency devaluation. To them, gold is protection. And it's not only governments. Many billionaire investors are buying gold as well. Ray Dalio has publicly recommended having 5% to 10% of investment portfolios in gold. Stanley Druckenmiller has reported owning significant gold positions. Paul Tudor Jones has also said he keeps gold as a hedge against inflation and against the weakening of paper currencies. Gold is currently around $2,450 per ounce, an all-time high, and the main reason is that informed investors are carrying out the second trade right now. After raising cash in the first trade, they are now shifting part of that cash into gold to preserve their wealth. When the next crash hits, the Federal Reserve will likely respond with massive money creation again, and the dollar could lose 20% to 30% of its value. If that happens, gold could surge to $5,000, $6,000, or even $10,000 per ounce. Investors who own gold will protect their purchasing power, while those holding only dollars or dollar-based investments may see their savings shrink dramatically. The second trade, building gold reserves, is already underway in a major way. The third trade is the volatility bet, the profit stage. The first trade protects your money. The second trade preserves its value. The third trade is designed to grow your wealth during the crash itself. The third trade is the one that creates major profits. It usually takes place 6 to 12 months before a market crash and involves financial tools that increase in value when markets fall. Here's how it has worked in past crashes. In 1929, after Joseph Kennedy moved into cash and Bernard Baruch shifted into gold, the next step was to make money from the coming decline. The main tool available at the time was short selling. Late in the summer and early fall of 1929, Kennedy began shorting multiple stocks. Shorting works by borrowing shares, selling them immediately at the current price, and then later buying them back at a lower price before returning them to the lender. While prices were still rising in September, Kennedy had to pay fees to maintain those borrowed positions, but he stayed patient because he understood the bigger picture. When the market crashed in October, stocks dropped 30% within days and 50% within weeks. Kennedy bought back the shares at the newly collapsed prices and returned them to the lenders. The difference between his selling price and his buying price became pure profit. Estimates suggest he made between $15 and $50 million from his short positions, worth several hundred million in today's dollars. He spent money waiting for the crash, then earned an enormous payoff when it arrived. The same pattern appeared in 1987. Paul Tudor Jones's third trade is famous because a documentary crew happened to be filming inside his trading office at the time. After he had raised cash and bought gold, Jones bought a huge number of put options on stock index futures. These options gave him the right to sell at a set price. For example, if he bought puts with a strike price of $2,500 when the market was trading at $2,700 and the market fell to $2,000, each contract would be worth 500 points in profit. Jones purchased thousands of these contracts, spending millions in option premiums, and then simply waited. When the market crashed on October 19, 1987, the Dow fell 22.6% in one day, the biggest single-day percentage drop in history. Jones's put options skyrocketed in value. He made about $100 million that day, and his fund gained 62% during the month of October alone. The documentary recorded him executing trades in real time as the profits rolled in. Just like Kennedy, he paid costs up front while waiting, then earned massive gains when volatility spiked. The 2008 example is best known from the book and movie The Big Short, but the mechanics are worth understanding because they show exactly how Trade 3 works. Michael Burry couldn't directly bet against subprime mortgages because there was no financial instrument for that at the time. So he worked with Goldman Sachs and other banks to create something called credit default swaps on mortgage bonds, essentially insurance contracts. Burry paid annual premiums of about 2% to 4% of the insured amount. For example, if he bought protection on $100 million in mortgage bonds, he owed $2 million to $4 million per year. If the mortgages stayed safe, he would lose the premiums, if the mortgages defaulted, he would receive the full insured amount. From 2005 to 2007, Burry paid these premiums while the housing market continued to climb, and his investors were furious because they didn't understand why he was spending millions on what looked like wasted insurance. But he knew the crash was coming, and the payoff would arrive once the mortgages started to fail. Many of Michael Burry's investors believed he had lost his mind. The housing market kept climbing, and his funds seemed to lose money month after month because of the premiums he was paying on the credit default swaps. But Burry understood how the third trade works. Patience is required because the payout only comes when the collapse begins. In 2007, defaults on risky mortgages started to rise. By early 2008, the mortgage bonds Burry had insured began to fail. When that happened, the credit default swaps triggered huge payouts. Contracts he had purchased for only a few $1 million in premiums produced hundreds of millions when the bonds became worthless. His fund earned more than $700 million. John Paulson made the same kind of trade, but on a much larger scale. His funds bought tens of billions of dollars worth of credit default swaps. When the housing market crashed, those swaps paid out $15 billion, over $20 billion across all of his funds. Paulson personally earned $4 billion. That was trade 3 at full power. Years of paying premiums, followed by the largest hedge fund payout in history. In 2025, trade 3 is happening again, and the tools being used today include credit default swaps on commercial real estate mortgage securities, put options on major stock indexes, and call options on the VIX, which rises when volatility spikes. The evidence is already visible. The price of credit default swaps tied to commercial real estate has soared. The cost to insure against defaults in commercial mortgages has risen 300% to 500% since 2021. Investors expect commercial property values to plunge because many office buildings are half empty due to permanent remote work. Loans taken out at 3% interest will need to be refinanced at 8%, which many owners cannot afford. Defaults are expected to happen in waves. Investors are paying high premiums now because they believe those swaps will pay out massively in 2025 and 2026, just like the subprime swaps in 2008. There is also unusual activity in put options on the S&P 500 and the Nasdaq. Large institutions have been buying puts that expire in late 2025 and 2026, which are direct bets that the markets will fall sharply during that time. The put-to-call ratio, which shows how many puts are being purchased compared to bullish call options, has been elevated above 1, meaning more big investors are preparing for a drop than a rise. This is a clear sign of institutional hedging, the same behavior seen before previous crashes. VIX call options tell the same story. The VIX rises sharply during crashes, so buying VIX calls is essentially a bet on extreme market volatility. Major purchases of VIX calls with 2025 expirations suggest some of the world's largest investors are positioning for turmoil. Bill Ackman, who famously turned $27 million into $2.6 billion during the March 2020 crash, has hinted publicly that he is once again setting up defensive trades, even though he hasn't disclosed his exact positions. The pattern is unmistakable. In 1929, 1987, 2008, and now 2025, the same sequence of 3 trades has occurred. First, the smart money moves to cash 12 to 18 months before the crash. Second, they shift part of that cash into gold to protect their wealth. And third, they place trades designed to profit from the crash itself. Trade 3 involves buying financial instruments that rise in value when markets crash. These strategies are not random guesses. They are predictable responses to the same conditions that appear before every major market collapse. Prices rising far beyond reality, too much borrowing across the system, and a trigger that forces investors to sell all at once. Those who understand this pattern use the same 3 trades every time. To understand why these trades work, it helps to look at how market crashes actually unfold. Every major crash follows the same 4 stages. First comes the bubble. Asset prices climb to levels that no longer reflect real economic strength. In 1929, stocks reached unbelievable valuations. In 1987, prices were stretched and investors were drowning in borrowed money. In 2008, housing prices doubled in only 5 years due to careless and dishonest lending. In 2025, the Buffett indicator sits at around 185%, meaning the total stock market is valued at nearly twice the size of the entire economy, one of the most extreme readings in history. The second stage is euphoria. During this phase, people convince themselves that prices can only keep rising. In 1929, even a shoeshiner was giving out stock advice. In 1987, many believed computer-based trading would guarantee endless gains. In 2008, the popular belief was that home prices never fall nationwide. In 2025, artificial intelligence is the dream. The idea that AI will reshape everything, that profits will multiply forever, and that valuations no longer matter as long as you keep buying. The third stage is maximum leverage. As prices rise, everyone borrows to make even more money. In 1929, investors bought stocks with 90% borrowed cash. In 1987, portfolio insurance combined with program trading created hidden layers of leverage. In 2008, subprime lending and complex derivatives created leverage as high as 50 to 1 throughout the system. In 2025, margin debt is near all-time highs, and borrowing is once again everywhere. The fourth stage is the trigger, the event that causes the bubble to burst. It doesn't have to be huge on its own. In 1929, it was a fraud scandal in London. In 1987, it was a mix of rising interest rates and trading systems breaking down. In 2008, it was subprime mortgage defaults. In 2025, the trigger could be a wave of commercial real estate defaults, a geopolitical crisis, or the sudden collapse of a major technology company. The exact event is not what matters. What matters is that when the trigger hits, the conditions created during the bubble, the euphoria, and the buildup of leverage make a crash unavoidable. What truly matters is that once a trigger appears, it sets off the fifth stage, forced liquidation. Investors who borrowed money to buy assets start losing money when prices drop, and their brokers demand more funds to cover the losses. If they can't provide the money, they are forced to sell their investments. This selling pushes prices even lower, which then creates more margin calls and even more forced selling. It becomes a chain reaction, a downward spiral fueled not by real economic weakness, but by the mechanics of forced selling. This is why crashes happen incredibly fast. They don't unfold gradually. They happen in a wave of liquidation. The sixth stage is panic. Fear takes control, and everyone rushes to sell. People stop caring about what they own or whether the asset has long-term value. They simply want out of the market. Buyers disappear, and it becomes difficult to find anyone willing to purchase at reasonable prices. Prices then drop sharply from one level to the next. Market volatility skyrockets, and the overall market can fall 20 to 40% within just a few weeks. This is the true crash moment. And it is exactly when the three trades deliver their biggest benefits. Holding cash means you avoid being forced to sell, so you stay safe while others are being liquidated. Holding gold means your wealth remains protected if the Federal Reserve pumps more money into the system to stop the crisis. Holding volatility-based investments, such as put options, credit default swaps, and VIX calls, means you actually profit from the sharp decline while others are losing a huge portion of their portfolios. These three trades work together because they align with the mechanics of how crashes unfold, and that is why they have proven effective every time. So where do things stand in 2025? We are in the late stage of positioning. The first trade, moving into cash, is largely finished. Major investors have raised record amounts of cash. Warren Buffett has over $325 billion sitting idle, and insider selling is at levels last seen in 2007. The biggest players have stepped aside. The second trade, increasing gold holdings, is speeding up. Central banks have purchased 3,000 tons of gold in 3 years, and gold is at record prices around $4,500. The wealthy are clearly protecting their capital. The third trade, preparing to profit from volatility, is now being built. The cost of insurance on commercial real estate debt has jumped sharply. Institutions are buying large amounts of put options, and activity in VIX call options is rising. The bets that pay off during market chaos are being set up. Because all three trades are now visible, the timing matches the historical pattern. We are likely 12 to 18 months away from the next major crash. It could come sooner if a sudden trigger speeds things up, or a little later if optimism keeps prices inflated for a while longer. But based on the pattern, the window is clear. Within roughly 18 months, a major market decline is expected. When it arrives, if the S&P drops from current levels near 6,600 down to 3,500 or lower, if commercial real estate collapses, if regional banks fail, and if unemployment jumps from 4% to 9%, the three trades will deliver their payoff. Those holding cash will be in the strongest position, ready to buy valuable assets at bargain prices after the crash has run its course. Investors who hold gold during a market crash protect their buying power because gold tends to rise when the dollar loses value. Investors who bought volatility-based assets, such as put options and swaps, can receive large payouts when markets fall sharply, since those instruments gain value during chaos. After these three trades succeed, a fourth, implied step follows. Once you've protected your capital, maintained your wealth, and made profits during the crash, the goal is to invest when fear is at its highest. That means buying stocks after they've dropped by half, buying real estate when properties are being repossessed, and purchasing businesses that are being sold at extremely low prices. This is exactly what Joseph Kennedy did after the crash of 1929, what Warren Buffett did in 2008, when he invested $5 billion in Goldman Sachs near the market bottom, and what Bill Ackman did in 2020, when he used his $2.6 billion gain from hedging to buy stocks that had crashed. This final step, buying at the bottom, is how generational wealth is created. But it's only possible if the first three steps were completed successfully. So, what should the average person do? Most people can't follow this strategy perfectly. They don't have massive capital or access to specialized financial products used by large institutions. But simply understanding the pattern gives you an enormous advantage, and you can apply simplified versions of the same strategy. First, increase your cash position. For example, if 60 to 70% of your portfolio is in stocks, consider reducing that to 40% and keeping the rest in cash or short-term treasury bills. You might miss a bit of upside if the market rises, but when a crash comes, that extra cash becomes valuable buying power. Second, allocate part of your portfolio to gold, around 5 to 10%, ideally physical gold or gold-backed ETFs. When the Federal Reserve prints large amounts of money during a crisis, gold typically surges and protects purchasing power. Third, buy protection. A simple version is purchasing put options on the S&P 500, SPY. This is not overly complex. You buy puts that expire in 6 to 12 months with strike prices slightly lower than where the market is now. It may cost around 1 to 3% of your portfolio. If markets crash, the value of those puts could multiply many times over. If markets don't crash, you lose the premium. The same way you lose money spent on insurance when nothing bad happens. More than anything else, mental preparation is essential. You need to be emotionally ready to take action when fear is at its peak, to stay calm when the future looks uncertain, and to remain disciplined in sticking to your plan. When the crash hits and the market has fallen 40 to 50%, when headlines predict economic collapse, unemployment rises sharply, and banks start to fail, you must be prepared to act rather than panic. This means already having a list of strong companies you want to own, businesses with solid finances, low debt, and products people will continue to buy, no matter how bad the economy becomes. Think of companies like Apple, Microsoft, Visa, Johnson & Johnson, or Procter & Gamble. When their prices drop by half, that is the moment to buy using the cash you saved in the first step, the purchasing power you protected with gold in the second step, and the profits you earned from volatility trades in the third step. The key is to invest boldly when most people are frozen in fear. This is the most difficult part of the entire strategy. It is not the technical skill needed for the first 3 trades that separate successful crash investors from everyone else. It is the courage to buy when the world feels like it is falling apart. All of the legendary investors who profited from market crashes, Kennedy, Baruch, Paul Tudor Jones, Burry, Paulson, Buffett, and Ackman, had this mental strength. Acting in the moment of peak fear is the true secret. Based on historical patterns, we appear to be about 12 to 18 months before the next crash. That suggests a likely crash window in late 2025 or the first half of 2026, though it may occur slightly earlier or later. The 3 major preparation trades are already underway. Large investors are building cash positions, buying gold, and placing volatility bets. When a trigger event hits, whether it is a wave of commercial real estate defaults, the failure of a major bank, or a geopolitical shock, the downturn will accelerate rapidly. Markets could fall 20 to 30% within weeks, and then drop another 20 to 30% over the following months. Panic will peak around mid to late 2026. Unemployment may rise to around 9 to 10%. The S&P 500 could bottom near 3,500. Bitcoin could fall to around 20,000 or lower, and gold could soar to 5,000 or more as the Federal Reserve prints massive amounts of money to stabilize the system. That moment, when fear is overwhelming and prices are at their lowest, is when the 4th and final trade happens. You deploy the cash you saved and the profits you earned to buy high-quality assets at extremely discounted prices. Then, you hold those investments for 5 to 10 years as the market recovers, potentially tripling or quadrupling your wealth. That is the full pattern. 4 key moves carried out over roughly 18 to 36 months. When this strategy is carried out correctly, it has the power to build lifelong, even generational, wealth. The important takeaway is that the 3 trades are not secret tricks or privileged insider information. They are part of a well-documented pattern that has repeated again and again because financial crashes always follow the same chain of events. Prices become too high, borrowing becomes excessive, a trigger event appears, forced selling begins, panic spreads, and the market collapses. The investors who recognize these warning signs prepare in the same 3 ways every time. They move into cash, they buy gold, and they invest in assets that rise when markets fall. These trades worked in 1929, they worked in 1987, they worked in 2008, and the same approach is being used right now in 2025. by some of the most successful investors on the planet. Warren Buffett, holding $325 billion in cash, reflects the first trade. Central banks buying 3,000 tons of gold reflects the second, and hedge funds purchasing credit default swaps and put options represent the third. The pattern is already unfolding. The real question is whether individuals will pay attention to it or ignore it and remain fully invested through the crash, risking a loss of 30 to 50% or more of their wealth. Most people will overlook these signals, just as many did in 1929, 1987, and 2008. They will convince themselves that this time is different, that new technology guarantees endless growth, that the Federal Reserve will prevent a crash, or that valuations no longer matter. History suggests those who think this way tend to lose the most. But a smaller group will recognize the pattern and execute their own simplified versions of the three trades. They will protect their savings, preserve their purchasing power, and profit from the downturn. Then, when the market reaches its lowest point, they will reinvest and build more wealth than they ever expected. In the end, it comes down to personal choice. The three trades are already underway on a global scale, and the pattern has begun repeating once again. A crash appears likely, and smart investors are already positioning themselves. If this explanation has helped you recognize a pattern you hadn't noticed before, you can stay informed by following along as future signals emerge, from insider stock sales to central bank gold purchases, to rising prices of default insurance and other signs that the crash is approaching. The goal is not to create fear, but to understand how markets behave and prepare accordingly. This is not a recommendation to buy or sell anything. It is simply pattern recognition. The same sequence has played out multiple times over the last century, and it appears to be forming again. Once the crash is underway, it becomes too late to prepare. The trades must be made before the market falls. That's the entire point.